Oh, look at that. Here we go. Look at that. Look at that. Who's seeing this? Out of here. Algos are here. Algos are here to stay. Up 33%. Look at this. Interesting. Interesting. Okay, that's why it's very important to... Okay. My one runner's up 47%, guys. It's 640s. All right. If you took the puts, if you held those puts, right, we discussed that as very important to liquidate, not have anything, or that weekly open is 640 to 86. Okay, so please, I don't want anyone to get hurt. Okay. If you have those further dated contracts, my runner's up 51%. All right, that's about $250 per contract. Further dated contracts, of course, are a little more expensive, but when they start to go, they start to go. Powell didn't even say a word. Talk about priced in. The VIX has not budged, guys. The VIX has not budged. Where's Powell? Everyone's waiting for Powell. Okay, make sure to like the video. Make sure to subscribe. Just shy of that healthy pullback. Just shy of the healthy pullback. We're at weekly open. Pressure's on the bears now. Pressure's on the bears now. Please be careful, guys. All right, please be careful. $5 in 2 minutes. That's the now the VIX is falling apart. Now the VIX fell off a cliff. Delayed reaction by the VIX. We saw it here first, guys. Nice push to the upside. Where's Powell? Everyone's on standby. My 640s. The swing trade idea. One contract up 73%, guys. This is the power. You never know. I mean, it looks nice if you're right, but you have to be willing to sit through this. And let me tell you something. If you're in puts, you're not getting filled here. It's going to be very difficult for you to get filled on this candle. Okay? There's a lot of slippage. If you saw the way this candle formed, you know exactly what I'm talking about. All right? All-time high around the corner, team. All-time highs around the corner. 643. The Dow, all-time highs. Intraday. This is insane. Wouldn't it be something if they reverse this entire move? Powell hasn't even took the stage. Are they going to cover it or what? CNBC, what's going on?
Diminished, but the unemployment rate had increased by almost a full percentage point.
You're disqualified.
A development that historically has not occurred outside of recessions.
Never again.
Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy
CNBC is too slow.
setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity.
Right off of that zone. Tesla.
There is significant uncertainty about where
Nvidia,
all of these policies will eventually
Microsoft,
settle and what their lasting effects on the economy will be.
Amazon.
Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report released earlier this month showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall,
yeah, I'm an AI, but I'm here to talk apps. Real apps you can build in minutes with basic.
Come on. All right, so the move already took place. If you're just joining us for the Jackson Hole, we did see a massive move on all the indexes, all the Elite 8, all the Mag 7 names just took a pop to the upside, and market is back near all-time highs. The Dow did make all-time highs here and continues to push. So the Dow was the front runner, and the rest of the market caught up to that nice move to the downside. As long as the VIX continues to push to the downside, guys, this thing has more room to the upside, and all-time highs are on the clock. Right, all-time highs are on the clock. We can't see a nice push there. We're just $3 away. Right, we're just $3 away, and we're sitting right at weekly open. So it's basically like we're just even, like nothing happened on the week. Okay.
Based on the latest available data, indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together,
This
what are
hourly
the
candle is
implications
insane.
for monetary policy? In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear
job,
sense
JB.
of how we think about
You scalped
monetary
it for
policy,
8. Beautiful.
and that understanding is important both for
Beautiful.
transparency and accountability,
High risk,
and for making
high
monetary
reward.
policy more effective. The changes we made in this review
Folks on YouTube, make sure to like the video.
ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the
VIX now
structure of
below
the economy
15.
and our understanding of those
All-time high
changes.
within striking distance.
The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021,
wow, all-time highs with this striking distance, guys.
Fairly quickly without
the
a sharp
contracts are
tightening
$6 in the money.
Policy stance, as this
$6 in the money.
When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over
up
16
83%.
months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the
We're less than
economic
$1
landscape.
away from all-time highs on
Instead,
SPY.
we noted that our
The Dow
monetary
already made
policy
all-time
strategy
highs.
is designed to promote maximum employment and stable
Hughes,
prices
outta
across
here.
a broad range of economic conditions.
Hughes
The
has some ground
difficulty
to
of
cover.
operating near the ELB remains a
About
potential
$9
concern,
away.
but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework
above
of
daily
flexible
upside
inflation
target, too.
targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced
VIX
our
below
2020
15.
changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher, and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities.
A lot of huge orders hitting the time and sale.
Our 2020 statement said that
Time
we
and
would
sale
mitigate
accelerating.
shortfalls rather than deviations from maximum
Seeing some
employment.
profit taking here.
The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period
Wave
above
two
mainstream
being tested.
estimates of its sustainable level,
Second
along
wave
with
being
inflation
tested.
running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run, at times, above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding
Wave
concern.
4 under pressure. Headed to weekly open, 640 to 86.
There is a great deal of continuity with past
Projection now
statements.
645
The
psychological
document
level.
continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business
Potential head and shoulder reversal
while
pattern
also
brewing.
providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City
Weekly
staff who
open.
work so diligently to host this
Being
outstanding
tested.
event annually, counting a couple of virtual
9 EMA
appearances
has not
during
been
the
tested yet
pandemic.
on the
This
5.
is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
That was Fed Chair Jerome
Thank you,
Powell
Powell.
wrapping
Thank you,
up his
Powell. Thank you,
annual
Powell.
Jackson Hole remarks.
Thank you, Mr. Powell. So that wraps up his comments, guys. Next on the docket, we have the president speaking at 12 o'clock. So don't go anywhere. Make sure to like, make sure to subscribe. We'll just cover what took place. We saw a monster parabolic move to the upside before he even stepped on the stage. As soon as he stepped on the stage, started making those comments, right? He didn't say anything new, just basically reinforcing the things he's previously has said before. And we saw a nice continued push off that once we reclaim that weekly open. So where are we? Bigger picture, where are we? So let's go back to the higher time frames for a second. This morning, during the game plan, we discussed. First, let's rewind a little bit. That 20 EMA retest. This is how you identify those setups. That 20 EMA retest on the daily, that was up for question. All right, we were early on identifying it with this hammer candle, and now the runners did peak at 60 plus percent. They're still up 80 plus percent, where they're still up 61%. But this is the one I want to bring to your attention. All right, so this was a technical formation on the daily. So this technical formation happens to favor the comments. So there's room for us to continue to push the upside. I don't think we'll have this kind of same reaction if we're at all-time highs today. Since we pulled back naturally into that 20, just below that 9 on the daily, we went 212, hammer, buyers are there. Buyers are there. They're just looking for a reason to re-engage. This thing gets pushed back to the upside. All right, so that daily was nice. We can see on the weekly now. We completely flipped that weekly. This morning we discussed the importance of that 50% retrace on the weekly. Now we know. Bears had a chance. All they had to do was take out that weekly downside break, which they did. Step 1, step 2, keep price below 50% retrace on the weekly. They failed to do that with the comments. We continue to accelerate the upside. Now it's a different ball game. Now all those shorts down here are trapped. They have to cover, creating that squeeze. All right, so now the sentiment is completely changed, and we're back in continuity with the bigger time frames. So this is how you trade that continuity back at the bigger time frames. You want to see a little bit of conflict in the lower time frame, especially the daily, a little bit of the weekly, and you want to trade it back into the higher time frames. To give you some context. So to break down what really took place intraday, of course, we can clearly see we made this parabolic move. Don't let these candlesticks fool you. For you to get real context, you have to be watching live. Okay, you have to be watching live. From this point on, before Powell took the stage, this candle, the way it formed, it was gapped up, to say the least. My technicians know what I'm talking about. Right, this was almost like so much algorithmic buying. It wasn't a natural candle. This 1 minute candle, team, folks joining us, this 1 minute candle, this is an anomaly. We don't see 1 minute candles as large. A 4-point move on this 1 minute candle. That 1 minute candle, to give you context. Okay, context is key. Daily ATR is 5.56 points. That's the average so far. This 1 minute candle was close to 70% of the daily ATR. In 1 minute, we covered 70% of what we usually move in the entirety of the day. Ton of buyers step in. We see that nice push, downward compression off that first wave. We push into 645 psychological level within striking distance of all-time highs. We see some weakness, and what do we identify here? A potential head and shoulder reversal pattern taking place. Right, see if that continues to play out. Right shoulder, where is that forming? Right there. And now the pressure is going to be on the bulls to step up off of this neckline. If they can't step up off of this neckline, we might see a nice push back into VWAP. So that this neckline coincides beautifully with the weekly open. Okay, with the weekly open. So this time, guys, this is for your technical, for you to really, you need to be a technician to really see what's going on. This is when your technicals get put to the test, and you get to see this action. It's exciting. It's exciting. You get to see these things happen in real time, and then boom, we're above that weekly open. So that was a massive move to the upside. A couple of you capitalized off that flag right here, off that first wave, somehow, some way. Great job for those of you who did that. And now we're seeing a little bit of pressure, but I think, in my opinion, as long as we stay above, as we said, just like we said at 9 a.m., as long as we stay above 50% of the weekly at the end of the day, bulls are here. The bulls are here, and they're here to stay. Right? Bears had their chance. We made a last-minute rally. Bears had their chance, and then now we made a parabolic move to the upside. Look at this move. What was on watch in the pre-market game plan? Breakout watch, multiple days. We finally break out. Is it a coincidence that the technical patterns play out when we have a catalyst? or they make parabolic moves when there's a catalyst. No coincidence. Right, so no coincidence. And now we're back in zone 3 within 29 minutes, guys. Powell spoke for less than 30 minutes and moved the market by 8 points. In 30 minutes, Jerome Powell moving the market by 8 points. All right. That's the most powerful man on the planet to me. All right. 8 points. He didn't say much. He just reiterates the same thing. Okay. This is all sentiment. This move is sentiment based. All right. As long as he's not switching his tone, it's all sentiment based. Unless he says something out of left field, right? The market has a little bit of certainty. The market works off of certainty and uncertainty. If the sentiment is not changed, if the sentiment reiterates the same thing, that's certainty. Market loves it. Uncertainty, market doesn't like it. Doesn't know how to price it in. All right, so parabolic move there was awesome. For those of you to capitalize off that, great, but it was awesome just to watch it from a technical standpoint. And the VIX completely collapses back to the downside. But the one thing I want you to do is go rewind and see this candle. This candle was so massive that VIX didn't even know what to do. It didn't even react. It was frozen. Right? It was frozen. The amount of buying that took place there, whether it was natural buying or systematic buying, whether it was algorithmic buying, it was historical. Right? It was a complete outlier. 8 points. 6 points on a 1 minute candle. All right, so